welcome back. Up next, we're thrilled to have with us industry leaders coming from the two ends of the market spectrum. Their firms have been dominating forces in the public and private markets respectively, and are both looking to expand into the other markets. They share their perspectives with us on this hybrid investment approach and other markets dynamics in this next panel. Let us now welcome our moderator, Darryl Chen from the Hong Kong Monetary Authority, and joining him on stage, we're honored to have Jonathan Gray from Blackstone and Emmanuel Roman from PIMCO. Darryl, over to you. Thank you.
Okay, welcome back. And good morning to everyone. Welcome, John. Welcome, Manny, for joining us today. And now, this panel is about best of both worlds. And so we'll be covering both public and private markets. But let's start with something less clear-cut, which is the convergence or the blurring of the two markets. John, since you took up the current role, you doubled the AUM of Blackstone, and now you're the biggest alternative asset manager. And for many, since you took over the PIMCO role, you turned around the fixed income business, and you're now truly a bond giant. So my first question to both of you is that, okay, you seem to be doing remarkably well in your respective space, but why are you interested in the other's playground?
Oh, I love that question, Darryl. It's great to be here. Congrats to Eddie and everybody at HKMA for another great conference. I guess I'd say it a little bit differently, which is what we've really been on is a journey to expand access to private markets. That if you went back a couple decades ago, we had just a couple hundred customers, pension plans, sovereign wealth plans, funds, endowments. And what we've been trying to do is say, how can we expand the benefits of the higher returns from alternatives, the diversification benefits? What can we do? And so we've expanded with insurance clients, more institutional clients. And then in the wealth arena, the idea has been, can we create products that others can access? And so we started 20 years ago with individual investors in drawdown funds, about a decade ago in these semi-liquid funds, and now we're moving towards products that partner with best-in-class liquid managers. We've got a growing partnership with both Vanguard and Wellington in active and passive liquid, both debt and equity. And the idea is, if we partner those with our products, can you offer something really compelling to individual investors? I think it's a similar story in the 401k arena, where we're likely to partner with leading liquid providers as well. So it's not really about expanding our footprint so much into the liquid arena as it is expanding privates and what we do in order to give those differentiated returns to individual investors.
Well, thank you. That's a great story. I think the 401k was certainly something very exciting, looking forward to. So, Manny, you want to fight back, right?
Well, thank you for having me. No, I'm not going to. Let me take another stake at this. Let's say you build a portfolio right now, investment grade, you get to something like 7% yield. Yep. And the yield is a good forward predictor of future returns. So keep in mind the 7%. Now I want to increase the yield. There are three ways to doing it. Leverage, going down in credit quality, and becoming more liquid. There's no miracle. That's the way you get to higher return. And it may or may not be attractive depending on relative value. So John needs to borrow money for his private equity business. I don't do private equity, but he's a fiduciary, right? So he's going to try to borrow money. He's going to call his 10 closest friends. I'm one of them. And he's going to try to get the best deal for his leverage buyout. And there's a classic problem of Unis curves. And so if I can get 7.5 in direct lending in a weak single B credit, he's doing his job. I may not doing mine because I don't think it's that attractive. Right. But if I can get 10, then I think it's very attractive. And so it's all in the price, and I think you have an equilibrium where everyone is trying to do the right thing, but market prices dictate behavior, and one shouldn't take illiquidity for the sake of taking illiquidity.
So I think that's the point that it's really about return, but for John's case, it's really about access by the smaller investors. So maybe before long, we're going to see tokenization of private equity in some case. Anyway, but it seems that these are two very different markets. So in terms of investment strategy, your philosophy, your risk management, and also, do you also see the kind of synergy or complementarity of getting into two different markets?
Well, I definitely think there's a complementary nature of bringing liquid assets next to private assets. If you think about the liquid market is so important for investors, but the S&P 500 today is 10 stocks or 40% of the overall market cap. And we know there's obviously a lot of volatility, sentiment moves things. We saw that certainly during COVID or after Liberation Day, liquid markets move very, very quickly. So the idea of having some ballast for investors, institutional, insurance companies, individuals, makes a lot of sense. You know, what it gives you is exposure to real estate at much greater scale than you can get in public markets, things like infrastructure. Something like almost 90% of the private companies in the US that have more than $100 million in revenue are private. And so to be able to construct a portfolio that gives you access to all of those companies and puts it side by side with your liquids portfolio makes sense. So no one's up here saying you're going to put 100% of your assets in private markets. But should you put 10, 20, 30%, most of the big institutional clients we have put about a third in, because again, the premium returns and the diversification benefits. So to us, this is just sort of a natural journey. It continues to expand, but again, you have to deliver for the clients because they are trading away a measure of liquidity.
So let me take a slightly different angle. In fixed income, you have a biodiversity second to none. So you have a very liquid market, you have structured product, you have asset-backed finance, you have a municipal bond market, you have more exotic type of payout like royalty finance and aviation and so on and so forth. And so at any point in time, different segment of the market may be more or less attractive depending on what the opportunity is. So I think either Ted or David mentioned before that investment grades are very, very tight. They're tight. It's good for John to borrow. It's less good for me to invest. And high yields are very expensive. You know, we have this chart which shows that between 1992 and 2008, you made 70 bips a year owning high yield. You lost everything in 2008 and more. And so we haven't seen a recession. And so to some extent, some of these returns in higher octane type of fixed income haven't been really tested. And I'm not being provocative. I'm making a very obvious point that in a growing economy, when things are good and there's no recession, things look better than they ought to on a risk-adjusted basis.
Yeah, that makes a lot of sense, I mean, in terms of allocation. So let's move on to the next question, which is about private markets. Now, John, the first question is, some say that the private credit space has been having a lot of strong traction in recent years, and that partly has to do with the challenges in fundraising as well as exit in the PE space. What's your take on that?
I see it a little differently, Darryl. I think it really has happened because of the excess return you've been able to deliver. If you think about what private credit is, we're bringing an investor, let's say an institution, right up to the borrower, and in the process, eliminating a lot of origination, securitization, all those costs that ultimately take away from the individual, from the ultimate end investor. And so when you're able to have that direct-to-customer model, farm to table, you can deliver higher returns. For our insurance clients with private investment grade, we've been delivering in the last year 170 basis points premium. So if you can deliver 7% instead of 5%, that's very helpful. Similar story in the leveraged loan market versus direct lending, where again, by having that direct-to-customer model, you provide a premium. So that to me has really been the driving force. It was certainly accelerated after the inflation surge, after rates went up and spreads widened because you got these very, very high rates of return. But that cyclical element, as it goes away, doesn't take away from the long-term secular benefits of private credit. And so I think this trend will continue, and it will take up a larger component of investors' portfolios. Again, they'll still have a very large liquid fixed income portfolio, but just like they have a big public equity portfolio, they now have a larger private equity portfolio. It'll be the same dynamic in credit.
Okay, thank you. That's the upside, but let me talk a bit about risk in the private credit space. Now, in the media interview in August, you said, and I quote, "Private markets haven't been tested." And recently, we're seeing some high-profile bankruptcy cases in some private credit-backed investments. There's even mention of the crawling little creatures out there.
Not my words.
So, what's
No,
your
look,
take?
I think here's the way to understand it. You have a mortgage market which is super efficient. For lower quality borrower, you always had other form of financing where the credit is much worse, and then the risk of fraud is higher. I mean, I was telling you when we were preparing for this that I remember a case in 1999 which pretty much looked like the one we're seeing today. Right. And so if you've been through this and you've seen fake invoicing and all of these things that we both know about, I think you sort of mentally prepare for it and you make sure that you don't do it. And so that's, I think, part number one. How many more are there? I think it's very hard to tell. I think everyone in this room scrub their book and try to make sure that none of us are exposed to this. But it could be that one of the sector where you've seen a lot of activity, like software, for example, where AI is going to be a major disruptor, you're going to have a problem, not because anyone is doing anything wrong, simply because there's a business model that is being destroyed by technology. And I think that's, that's a Schumpeterian way of looking at an ecosystem, and I think that's, I think that keeps everyone in this room awake at night because, it's a good, bad thing in terms of what's happening.
John, you want to jump in on that point?
Well, I would agree with Manny's comment. I think these high-profile bankruptcies were interesting in that they were non-institutional borrowers. What we tend to do is lend to private equity firms or public companies. These were non-traditional borrowers. They also, it appears, committed fraud, asset-backed, where there wasn't really assets there. And then to look at that and say somehow, therefore, the direct lending market or the investment-grade private credit market is flawed, particularly where in both of the high-profile cases, these were bank-led situations, that seems like an odd conclusion. But it matters how people underwrite. And yes, you have to be mindful of what you're doing in the credit space. But I think these are both idiosyncratic. And when we look at the overall credit books of the banks, of public debt markets, of the private credit, you see very low default rates, very low losses. To me, that's more representative than a couple of these idiosyncratic cases.
Okay, thank you. So perhaps no need to grab the pesticides, at least for now.
Agree.
Oh, okay. So my next question is on AI. So everyone is talking about AI. We can't avoid that. Private credit and PE, big investors in AI infrastructure, data centers in particular. But there's also increasing concern whether there's actually a bubble out there. And so there's a guy saying that, well, okay, so this time it's probably a good bubble. Well, meaning that, well, the investment put into it, the productivity gain, that will actually benefit, leaving lasting benefit for the society, even if the shares collapsed. So do we have a bubble, good bubble or bad bubble? John?
I'm a little more optimistic. Whenever you have this kind of change, doesn't matter, railroads, electricity, the internet, there will be misallocations of capital, there will be bad business models, there will be people who lose, no question. And there'll be an excess of enthusiasm in certain areas. But the power of this technology is really remarkable. The idea of super intelligence at scale, at almost no cost other than electricity, That is really powerful. And when you start to think about the use cases in coding and customer service and content creation, the list goes on. And we're at the very beginning of these use cases. If you think aggregately, there's $60 trillion of labor spend. If this technology makes individuals, companies, 15% more productive, that's $9 trillion a year. That can cover a lot of spend for data centers and for gas plants and all the infrastructure that needs to make this compute power a reality. So I'm definitely aggregately more optimistic that what's happening makes sense because the size of the prize is so large, but acknowledging there'll be losses. The other thing, and I think Manny was very smart to point this out, is that everyone's focused on this bubble over here. I think what you have to be concerned about as an investor is the disruption that's coming. It could be lower value added IT services. It could be certain horizontal enterprise software companies. It could be what happens in the auto supply chain or auto insurance as a result of autonomous vehicles. I think underestimating what will happen, even if these changes take time and as multiples compress, as people get worried, that's the thing as investors we've got to worry about. There seems to be these days much more focus on the bubble and misallocation of capital. I think we also want to look behind us at the pace of disruption and what it could mean for our portfolios.
You also mentioned that Blackstone is actually placing AI on the top of your risk list. What do you mean by that?
Well, we're just looking at every deal that comes through the door, and we're saying in the first 2 pages of the memo, tell us about the risk of disruption. We're also looking at our existing portfolio and sort of saying, yellow, red, green, you know, how much risk do we have? Is there a way to exit this company faster or this credit faster? And then I would say, in order to reduce our risk, we're also really focused on the picks and shovels. So really focused on being the biggest investor in the data center space with long-term leases, really focused on the electricity that's needed for the data centers, for the robotics, for the autonomous vehicles. So I think as investors, you want to try to find ways to play this derivatively and reduce your risk because there will be some losses.
Thank you. Manny, you just did a great deal. So can you tell us a bit more about that? And then your thesis of investing in AI and apart from data
Well, I think the beauty of it, you know, in terms of, I mean, and you know, I'm a little biased because we just did a deal with our friend from Morgan Stanley, a $29 billion giant, lending to one of these companies. So, you know, I may have to eat my own cooking. But the company who issued these giant bonds all have AA or AAA rating. I mean, it's incredibly safe. And because the market valuation is so high, if you plug the amount of debt being borrowed in a Merton model in terms of debt to equity, you find that it's pretty riskless and very attractive. And, you know, whether they decide to go to the public market like Oracle or whether they decide to go private, we don't know. And, you know, once again, they have very good and very smart CFO who are going to optimize their borrowing ability, and that may be or may not be good for, you know, both of us, and that's totally fine. The one word of caution is that we don't know what inference is going to be in terms of AI, and there's a lot of possible outcome, and I think none of us really know. And I think I would sort of caution with what may or may not happen, because the degree of certainty you have 5 years from now, it's just very hard to know where we're going to be. So maybe we're not building enough data center, maybe we're building a bit too much. Who knows? And maybe the data center, some of it will be obsolete, or maybe they won't be. And I think there's a degree of uncertainty in every single big innovation cycle, and that's one of them. And I think we'll recognize this, and we'll try to ride the wave as well as we can. But sometimes you ride the wave and you fall in the wave, and so that's the.
Before it's too late.
That's right.
But I think that word of caution is very helpful. We don't have much time left, so maybe just one last question, moving closer to home. So we just discussed just now while we're waiting. So the public markets here in Hong Kong and in the mainland has been doing, well, the sentiment has come back quite well. So John, how about the private market?
Well, the private market lags a bit on this because as a private investor, your time horizon's longer. So when there's geopolitical uncertainty, when there's a lack of liquidity in markets, private market participants, you know, tend to fall back a bit. What's encouraging is the outcome of the discussions last week, where the economic tensions are starting to come down. We've definitely been believers of letting the tariff diplomacy play out, that it ultimately would settle, that it's in both parties' interests to get to a better place. The second thing is just the revival of the public markets, the fact that the Shanghai index is up big, the Hong Kong index, the IPO market here is now going to be the leading IPO market in the world this year. That signals to investors liquidity is coming back. So I think you'll begin to see more focus on private markets in Greater China. I think there'll be a lot of focus on the domestic market, on growth and consumption, on leisure, hotels, logistics. Those things make sense to me. And I think Hong Kong will probably be the tip of the spear here in terms of the recovery. You can feel people coming into this market. The sentiment is changing. And so this place has had a tough few years, but it feels there'll be some compelling opportunities, particularly in the real estate, which I know has been badly beaten up.
Well, of course, you are a big real estate guy, so well, that's a good news. Manny, on the credit bond side.
Very, very simple. I think every single investor we have is under-invested in Asia for very obvious reason. If you look at benchmark, Asia is a much bigger part of the benchmark than what they invested in, and so there's a flow of money. Some of it goes through global bonds, some of it goes through global equity, some of it goes to local equity. Hong Kong is the gateway to China and to Asia. It's the center. It's where every one of us has big offices, and it's the role you play. And I think it's very good in terms of capital markets, but it's going to grow. And remember that one of the flip side of what we've seen in the US is there are some countries like Canada and Australia who have more difficult relationship with the US, where their own capital market is not big enough to be able to allocate locally. And so all of a sudden, there is some rebalancing from the US to other part of the world, and you've seen the dollar correct by 10%. I don't think it's over, but I think you've seen some smallish realignment in terms of flow of funds, and I think you'll see some of this happening here in a positive way.
That's actually very good advice for us while we and the SFC are rolling out a roadmap to really grow our bond market here. Thank you so much for the advice. Now, we're out of time. Again, thank you so much, gentlemen, for your good advice. I just hope that you'll continue to capture the best of both worlds. Ladies and gentlemen, big round of applause. Thank you.
Thank you, Darryl, and our speakers. Please remain on stage for a group photo.